Welcome to TheoTrade. This is Don Kaufman. March 19th, 2021. Doing the TheoTrade weekend update here on a Friday afternoon. Is buying the dip dead in this marketplace? We're actually going to cover that and, well, a lot more. Let's actually jump right into it here on this update. A dangerous bond dynamic has obviously come into play, and that's going to relate directly into the S&Ps at this point in time. You know, to kind of recap a little bit of the action of this previous week is quite simply, listen, a little bit of sell side activity hits the S&Ps, nothing, you know, huge, not wicked sell side, a little bit of volatility kind of creeping into the marketplace, but it's the bonds that are actually driving much of this. Obviously, we heard from the Fed. What did the Fed do? Absolutely nothing. I mean, all they did is kind of reiterate, we're going to have low interest rates for a considerable period of time. If you did catch some of the news this morning here we are in on a Friday afternoon, but on of course Friday morning they did actually change the SLR, which is going to be pulled at the end of March, which caused a little bit of sell side activity in the S&Ps, but again, nothing huge. But let's discuss, again, what is going to be pivotal moving forward. Like this is a time where, you know, you can talk about some of the trade action till you're blue in the face pretty much in the S&Ps. And the S&Ps are literally a stone's throw off the all-time high. But the bond dynamic is literally holding the entire S&P pretty much hostage at this point in time. Again, so the bonds have been selling off quite readily. Okay, whether you want to look at bonds, whether you want to look at notes, hey, listen, whatever does it for you, right? And of course, with the sell side activity inside of the bond market, you have TNX. Now, the TNX is representative of the 10-year interest rate. The 10-year interest rate here is effectively soaring, okay? And for those of you that don't necessarily look at the TNX on a day-to-day basis, when it says like 17.54, that's 1.75% on the 10-year. Remember, the 10-year actually kicked off this year at what? 1%. Now it's straight up to like 1.75. Like, listen, I don't care who you are. You need to have respect for the fact that the 10-year on a year-to-date basis, okay, is absolutely exploding on a percentage basis. And that unto itself, and again, you know, some people are going to be screaming about inflation. It's neither here nor there. It doesn't matter whether you think there's inflation, okay? All that matters at this point in time, okay, is if these interest rates keep climbing, this interest rate climbing, what has it impacted? And the answer is, it's the Nasdaq. The Nasdaq, and I got to tell you, the Nasdaq, at least in my opinion, is faring quite well. I mean, the Nasdaq is pretty much flat on the year. I like to put it up at like a year-to-date basis. It's flat on the year. So for the most part, well, here, 1.24%. What's the S&P doing on the year? Again, give yourself a little bit of orientation. The S&P is 5.6%. But the dangerous bond dynamic that we're in right now, and I really want to dig into this because we're going to talk about financials versus tech, okay? And then we're going to talk about is buying the dip dead, all right, in just a moment here. But here's the dangerous bond dynamic that kind of exists. So again, as the sell side activity, so if we continue to sell off in the bond market, interest rates are going to go higher. If interest rates are going to go higher, you know, you're going to start to feel some really serious pain. All right, and some very key underlyings, Tesla being one of them. Tesla, of course, is incredibly interest rate sensitive. It's actually down about 10% on a year-to-date basis. But you start to look through some of the usual suspects. Apple's actually down 7% year-to-date. Okay, Microsoft is still faring well, but again, that remains to be seen if those interest rates keep soaring. So most of your major, again, what we kind of term monsters of tech. The monsters of tech are just that. They're Apple, they're Amazon, they're Facebook, they're Google, they're Microsoft, and combined, those products, they're still holding up. They're up about 4%. That's predominantly because the action inside of Google has been incredibly positive. Kind of curious about this. If you want to look at Amazon, Amazon's actually down 3.5% on a year-to-date basis. All right. So you understand a little bit of the bond dynamic, right? Well, the first step in the bond dynamic is a very simple one. If the bonds continue to sell off, I think it's actually going to smoke technology to a larger degree. I mean, tech is not going to find an easy way around that, again, especially at the velocity of the sell side activity inside of the bond market. But there's that catch-22, and I've been talking about this incessantly for the past 6 weeks. What happens if the bonds rally? I'll tell you exactly what happens if the bonds rally. If the bonds rally, then they're going to go after what? Then they're going to go after the financials. Okay? And the financials have just been flying right now. Look at them on a year-to-date basis. All right? Literally yesterday, they were actually up almost 22% on a year-to-date basis. Huge reversal inside of the financials in the last 2 days. Well, here's another kind of weird dynamic that's playing out because the Fed spoke on Wednesday and then actually, changed one of the requirements, one of the banking requirements literally this morning. That actually hurt the financials to a larger degree. I mean, the financials finished down today 1.16. In fact, if you take a look at the week, the financial actors, they finished just off the lower edge of the expected move on the week. So some sell-side activity starting to hit the financials. So again, a very, very dangerous dynamic exists in the bonds. The bonds rip back up, okay? The higher up the bonds go, that's going to take interest rates lower. That's absolutely unequivocally going to hurt the financials. But if the bonds continue to sell off in some kind of wicked fashion, it's probably going to take down tech, which brings me to my next point. Markets, they just can't find correlation. They cannot find the keys to correlation. This is one of the most pivotal things to understand in the entire marketplace right now. And this actually relates back to, is buying the dip dead? There's no question that there are still some wicked sector by sector rotations. All right, the whole sector rotations, financial versus tech, financial versus tech, financial versus tech is the sector rotation. And effectively, all we've seen kind of, day in and day out is we're like what? We're selling in technology. We're buying some of the financials. I mean, pretty much no matter what's happened this year, they've pretty much been buying the financials. But I would watch this dynamic very, very carefully because what that dynamic is doing, the financials versus tech, it's actually splitting the advanced decline line pretty much right down the middle. And there was a point in today's trading session. Today's trading session, we actually had a point in time where the S&Ps were down over 20. So the S&Ps themselves were down over 20, okay, and we actually had a very slightly positive advanced decline line. So why am I actually mentioning, correlation? Because what you're getting right now in the marketplace, and I really want to draw this up here, and I'll come back to this correlation in just a second. What you're actually getting in the marketplace as a whole, okay, is, and I'll kind of zoom in on this. All right, so we're gonna draw our own chart over here, which you've actually had this year. XLF, which are the financials, have been heading to the upside, okay? Then we actually have tech over here, and tech has actually been grinding a little bit lower, been chopping out to the downside. And effectively what you have, okay, is the S&P 500 kind of skirting through the middle a little bit. And that's actually what I'm saying. It's a dangerous bond dynamic. We cannot find correlation. But if we do, this dynamic is going to cease to exist. Financials versus tech is one of the most critical things. If you wake up one morning, and this advanced decline line, all right, starts to see higher degrees of correlation. What I'm talking about is like 90 products trading to the downside, okay? Then that dynamic is officially broken. And it's the most critical aspect of this marketplace at this point in time because, if you're thinking that we're in some chop volatility and the markets are just slopping around, okay, you haven't seen anything yet. I mean, yes, we're kind of grinding a little bit higher on the S&Ps, but net, this is a dangerous time, right? And that's what I kind of call S&P 500, okay, is stuck in the middle with you. There's another really just crazy dynamic that goes with this. So the Fed did nothing. The markets can't find correlation. You got this dangerous bond dynamic that's driving this financials versus technology in here. But then when I say S&P 500 volatility is stuck in the middle with you, what am I really referencing? And what I'm referencing in this case, and you got to check this out for what it's worth, okay? And this is something I've been mentioning a lot, like the TLT. Look at the 28-day volatility inside of the TLT, okay? 20-day like volatility out inside of the TLT is about 20%. Okay, so the bond volatility is just over 20%. Okay, got that one. Got it, Don. All right, next we come to the spiders. Go look at the spiders. Spider volatility, what is it? Almost exactly the same thing as the TLT, which is strange unto itself, right? That bond volatility and spider volatility are like one and the same. But then to go take a look at the QQQ, and everybody's like, oh, the QQQ is always more volatile. No, it's not. Okay, QQQ is clear up to like what, 30%. So the Qs are actually carrying what? They're packing a ton more volatility right now than the S&Ps. Gets good. It gets really good. Then I want you to take a look at the financials. The financials are also seeing about 27% implied volatility. So what you actually have is this really interesting dynamic that the volatility remains relatively high in the XLF. The volatility remains relatively high inside of the Nasdaq, but it actually drops inside of the S&Ps. I'll tell you where else volatility is extraordinarily high. The IWM. The IWM has actually still got relatively high volatility, okay, for a market that is what? Hey, listen, the IWM is effectively sitting near all-time highs over here, but its volatility is still sitting about 30%, and it has been. It has been sitting that high for quite some period of time. So that's kind of what I call S&P 500 volatility is stuck in the middle with you, is that the S&Ps, they're trapped between a rock and a hard place until we actually see higher degrees of correlation. And that also leads us to believe that the VIX, okay, let's actually cruise over to the VIX for a second. The VIX is inherently low. Okay, and the VIX is actually relatively low versus the previous 52 weeks. So actually, let's go all the way back to like a one-year chart in this particular case. Now, this one-year chart displays the onset of COVID. In fact, I'll even go back to a more substantial period of time, so you can actually see the full-on onset of COVID here. So this is, again, the onset of the COVID environment. This is actually the crash of COVID. We revert back down, but we're actually hitting some of the lowest levels of VIX that we've seen in quite some time. So what I've actually done is I've gone out and actually bought some VIX spreads like 60 days out. I didn't sell anything to be able to do this. I actually literally just bought VIX volatility spreads. So I'm doing this because the implied volatility is incredibly, okay, useful at this point in time. It's beneficial to understand, all right, your implied volatility and how I'm literally buying like 117 vol and selling 151 vol. Okay, so volatility is really favorable right now to be able to buy VIX call spreads. So I've got, you know, a little cheap shot on there inside of the VIX. Nevertheless, okay, I'm buying VIX at a low right now because I also have every intention of selling some options premium against it. Now let's get down to business, and the business is, again, I just wanted to kind of recap a couple of things in the marketplace, the dangerous bond dynamic. I wanted to recap a little bit of financials versus tech because that's what's going to be driving a lot of the order flow in the days to come. When I say though, let's get down to business, okay, buying the dip or fade any rip. Here's what I'm going to tell you a little bit about buying the dip. Okay, when people think, categorically speaking, about dip buying the marketplace, right? Very often they look at stocks like Tesla's, okay, and buying the dip in here, at least, you know, at this point in the year, has not been an effective means. Okay, if you bring up something like Apple, buying the dip has absolutely unequivocally not worked. Okay, on a year-to-date basis. All right, I could probably say a little bit of the same. There hasn't been much of a dip, to be frank with you, inside of Microsoft, but at this point in time, it's on a dip. Okay, then we look at something like the financials. The financials, okay, had a mild dip and an absolute rip. This thing would have blown away to buy the dip. Here's the absolute, like, you know, listen, I'm just going to be very, very forthright with you. Okay, it's bottom line over there. If you're going to be out buying dips, long stock, it's just not worth the associated risks. It's absolute unequivocal insanity to go out there right now and to try to, you know, categorically speaking, buy dips with long stock. I think it's futility. The other thing I would not even consider right now is, like, when the market starts to dip a little bit, and again, you start to look at some of the stocks that have had some sell side activity. Okay, when the market starts to sell off a little bit, some of the volatilities in a few of the Nasdaq stocks, like an Apple, they're still holding their own. I mean, listen, even Apple's got like a 30, 35, 36 volatility out there. And when it comes to, like, you know, some people actually look at volatility ranking. Even the volatility ranking inside of Apple is still close to like the 20th percentile. Nevertheless, okay, one of the things you don't want to do, you don't want to go out there and just buy calls, you know, because if you think Apple is going to rally, if you think Apple's going to rally, the moment that Apple were to rally, what would actually happen to the implied volatility? The implied volatility, the IV, is going to get crushed. So you better watch out right now in buying the dip, because we're in an elevated volatility environment. Okay, on every single dip in this marketplace, we're elevating IV. And the second we go back up, they crush the implied volatility and the life out of those calls. So long stock, first of all, long stock isn't going to be worth the associated risk. And I know that some people are like, well, my 401k only allows, listen, a lot of 401ks have self-directed components to them. All I'm just suggesting at this point in time, all right, if you want to buy the dip, you just, please, okay, listen carefully. Don't run out and go out and buy a bunch of stock because it looks like a wonderful deal, okay? You want to use spreads. You want to use synthetics. You want to use anything that is not going to put you, okay, at phenomenal risk. I mean, I'll give you another one that, here's a position that I actually have in Lululemon, okay? You want to buy this dip, okay? Looks pretty good, right? I mean, the stock's actually sold off a little bit. It's actually bounced a little, okay? Maybe buying the dip is not necessarily dead. Open up like a 3-year chart in here, okay? This is absolutely pivotal. And I'm using Lululemon just to display, okay, that risk reward of going out and actually physically buying a stock. You buy a stock over here, even at 300. Next thing you know, this thing could be trading 200. It could be trading 150. Okay, the risk reward here, this is just not viable. It's just not viable at this point. Then you start looking at stuff like financials. I'm serious. Open up to the bigger chart over here. Look at financials. Okay, nobody's ever seen a move like this in financials. Financials don't move like this. I mean, you can even compare this to, when was the other last explosion of the financials to the upside? You can go all the way back to the election of 2016 where the financials exploded up, but that pales in comparison to the action that we've seen over here, right? There's just no way that even if you want to get bullish inside of the financials right now, and I'm fine with that. I'm not here, okay, to tell you that dip buying is dead. I'm not, that's not the goal of, this weekend's update is to tell you that dip buying is dead. The goal of this weekend's update, okay, is to stress to you the risk reward isn't worth getting long the shares in any way, shape, or form. Long stock isn't worth the associated risks. You got to use spreads or you got to use some type of synthetic. What do I mean by like synthetic? All right, you can go out here and again, let's say you wanted to get like long the QQQ. Okay, so if you thought the QQQs like, hey, listen, Don, bonds are gonna rally. If bonds rally, the QQQ is going to rally. So how do you go about getting long the QQQ? Go into the trade tab over here, okay? Hey, we can even go out a little bit in time, okay? Go out a little bit in time. Of course, we could use a spread, a couple strikes in the money, couple strikes out of the money. We can actually alleviate a little bit of the time factor in this particular case. But here, again, I'm actually intentionally going to buy a big, huge spread, okay? This is $10 wide spread trading for probably around $5. Okay, and this is a way to give yourself viability to risk reward without actually overstepping bounds. And that's just one type of a spread. By the way, that spread was actually what we call Theta Neutral. Theta Neutral means because you're buying a spread, everybody assumes that you got time decay going against you. That spread absolutely had no time decay. Or if you think a big, just explosive move is going to come, if you think a bigger explosive move is going to come, maybe use some type of like back spread. Where you get let's get a little bit crazy, okay? If you think an explosive move is coming back to the marketplace, we could actually use like an at-the-money back spread in here, where we go out and literally create. When I say a back spread here, I'm not being facetious, where we actually go out and create a little bit of a back spread for a credit, and if we explode to the upside, okay, you're going to be the beneficiary of that. But of course, this trade, does entail quite a bit of risk between the short strike and the long strike over here. Okay, how else could you actually do this? I'll tell you what, one of the most simple ways when I say like, hey, long stock isn't worth the associated risk, maybe use spreads, synthetics can be extraordinarily helpful. What's synthetics? Listen, for the next week, if you want to buy the dip, I said, you can't go out there and just buy an out-of-the-money call. Buying an out-of-the-money call is going to be a huge risk because implied volatility can get crushed, okay? What you could use, though, is a deeper in-the-money call. A deeper in-the-money call, of course, is a synthetic long stock position. Or you could even come in here and actually trade, for instance, like micro Nasdaqs. Why not use something like micro Nasdaqs where you're actually buying the Nasdaq futures contract? And again, this could take quite a bit of risk over here, but it's a micro. I mean, it's a lot easier than going out there and trying to substantiate, the Nasdaq futures. Speaking of the micros, if you guys haven't seen this, the micro Nasdaqs trade like 1.33 million contracts today. If you take a look at the full Nasdaq contract only did about 600,000 contracts. So if you're kind of curious if the micros have taken off, they're stellar. All I'm saying in this particular front, okay, buy the dip or fade any rip. Hey, listen, for me, I find the risk reward in many cases, and again, I want to go back over to the financials, I find this a phenomenal risk reward. What's the phenomenal risk reward? I'm short, okay? And I'm significantly short. And actually, you can see I'm actually short at this point about 1,500 shares inside of the financials, okay? Why? Because I think I have viability on my side, again, for risk reward. You know, you ask yourself in a situation like this, what's the upside capacity versus the downside risk? And I'm comfortable actually looking at this and saying, I think the downside risks are considerable versus the upside potential, given the fact that on a year-to-date basis, it's already up, you know, and was up about 20% on a year-to-date basis. Think about that in every single trade. And if you don't have that favorable risk reward, okay, don't go out there and get long shares or short shares. Use spreads, use synthetics, use anything, people, to mitigate, okay, that just, you know, outlandish exposure that this marketplace is going to put you in front of. Last but definitely not least, in the weekend update, we always talk about the SPX. The SPX, the mother of all products. The SPX expected move of the previous week was about $73 and change. If this next week, $75.81. The reason I want to actually bring this to your attention, okay, is in this week of trade, we really did nothing on Monday, on Tuesday, and Wednesday. Some wicked sell-side activity hits the marketplace on Thursday. And I'll tell you what, on Friday, we made a valiant effort here during this expiration Friday. We came within $16, right in here. We came within $16 of actually hitting the lower edge of the expected move. People, we did not hit the lower edge of the expected move, which is precisely why I'm going to tell you this next week. We have an incredibly high probability of hitting the upper end or lower edge of the expected move. Okay. Now, again, on a $75 and change expected move, it's no different really than the previous week. So once again, what am I going to tell you? Get ready to rumble. I mean, a $75 expected move is not necessarily extraordinary. Okay. Nevertheless, okay, there's going to be some price action. The probability of touching the upper edge, and again, where's the upper edge of the expected move? My mouse is going to be on it here momentarily. Okay, the upper edge of the expected move is a hop, skip, and a jump away off the 4,000 level. It's 39, okay, basically 88. The lower edge of the expected move, you're looking at about 38, 36. Okay, where do we actually close this week? Just a hair short of the 3,900 handle. Throughout the course of this week here at TheoTrade, I will talk incessantly about the S&P futures. We have some really specific and kind of tactical levels inside of the S&P futures, but stay tuned, of course, throughout the course of this week here on TheoTrade Chat for some of those levels. With that, again, when it comes down to it, again, it's all about this dangerous bond dynamic. We're going to see a lot more play out in this next week of trade. Once again, I would look for volatility throughout the course of this week and some really good opportunities possibly to sell some premium. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.